Hey, Meb, welcome to the show.
Great to be here.
So, before we get started, can you tell everybody about your background and how you eventually got in your role as CEO and CIO of Cambria?
Well, that's the nice thing about being a founder is you get to anoint yourself with whatever title you want. So I think I have the whole C-suite covered at this point. I'm the chief trash collector and office cleaner and lunch coffee maker. Anyway, yeah, we're a little company based here in Manhattan Beach, California. Listeners, if you're not familiar, it's a little town, kind of part of LA, but far enough away to still show up in the office in surf gear and flip flops if you want to come say hi. We manage about 2.5 billion in assets. We've been launched our first ETF over a decade ago. We now have 15 funds and over 150,000 investors all around the world. As far as my background, I come from a engineering bent, a little bit of biotech mixed in, and so very much a quantitative, rules-based shop. And I'm happy to dig in more any of those alleyways.
Yeah, we're going to get into a lot of that stuff for sure. But, before we get into the nitty gritty, I always like to ask people what they like to do for fun when you're kind of not behind the desk.
Well, as any entrepreneur can relate, behind the desk is there may not be a physical desk, but there's a mental desk, which I love. I love our world of investment research, global macro. There's never a dull day, so I can't say it's not always on my mind. One of the nice things about being a rules-based investor, though, is you don't have a lot of the discretionary emotional, psychological trauma, I think, that many of my friends do in that world. But so, yeah, I mean, I grew up as a skier. I like to surf, though it's not native to me. So you'll see me out on the foam Costco board. If you're in the lineup, watch out. But any sort of adventure you can talk me into, I'm apt to join you. Love going fishing and traveling. We just got back from Japan. So yeah.
Yeah, Japan is on my bucket list. I haven't bit the bullet yet, but I've heard great things. My brother-in-law was just there and said he had like the best time he's ever had.
You come back and the yen's at like 160 now. So it's a great time as far as currencies. Beautiful country, beautiful people, wonderful food, all of it together. Although it's summertime, it's like being in Pittsburgh, man. It gets a little hot in July and August. So maybe wait till we turn the page to fall.
Yeah, head over to the fall. So staying on you for kind of one more minute, you push out a lot of content at the firm, and you personally, you do it very consistently, and you're also an author. How do you think all of those things might have helped scale Cambria over time?
Well, I just saw this morning that a fellow registered investment advisor, Ken Fisher, sold part of his business at a $13 billion valuation. Congrats, Ken. The reason I bring up Ken is, we weren't the first to do content. People have been doing this for a long time. Ken certainly did it for many years, publishing magazine articles and writing. You had others like Edelman, who spent a lot of time on the radio building his business, and both of those are $100 billion plus investment advisors. But you have people going back 50, 100 years. If you look at Charles Dow, who really started the Dow Jones and then the Wall Street Journal, Dow theory was writing a long, long time ago, Ben Graham. So it's always been a content and narrative driven business. The more modern era, we started out with academic papers. So I kind of made my first mark with an academic paper. Then it became books. Then it became blogs. And in the more modern age, it's podcasts and YouTube. And I'm told TikTok and who knows what's next. Maybe some holograms in the internet VR world somewhere. I don't know, but it comes down to do you have ideas in this internet age? It gives you a megaphone. It can be good or it can be bad, as we've seen. People, your ideas can circle around the globe pretty quick. So we like to put them all out there. A lot of non-consensus views, as I'm sure you know, on the investing world.
Yeah, no, it's great. It's funny when a handful of years back, probably 6 or 7 years ago, I had a two young kids graduated from the same college I graduated from. They listened to your podcast like religiously. They would block off that time, close their office door, and they were like, "We got to listen to Meb
Smart
show."
kids, tell them we're hiring. So if they
Yeah.
want to come join us in Manhattan Beach, we already know they're intelligent by listening to the show.
So let's talk about Cambria as a whole. You do a lot of other things other than just the ETFs. So can you talk about what all you do for clients?
Sure. I'll start by telling you what we don't do. And what we don't do is traditional financial planning, right? So, I think one of the most future-proof jobs of the next 50 years as AI comes for all of us is still that financial planning wedge, the advisor. And everyone talks about, their fees, compression, and everything else. But I'm talking about the really value add world of tax planning, of estates and trusts, of behavioral coaching, of legacy discussions with, not just the current generation, but future generations and multiple, people involved, this sort of outsourced family office type of environment. I think that's a job that will continue to have very much in demand. We don't do that. We talk a lot about it, and we spend a lot of time on the podcast talking about all the things that go into investing that's not just the arithmetic of investing. But for the most part, our business is largely ETFs, publicly available. We do a free research service called the Idea Farm that goes out to over 100,000 investors, trying to curate all this investment noise we see out there into really a digestible weekly email. That's a lot of fun. And so really it's the kind of dual mission of launching funds that anyone can buy, and then also as ETFs eat the asset management industry, but also to educate people as well, which is a big passion for us because, as we know, it's not taught in schools, or it's not taught in most schools. It's getting better. It's up to, I think, about a quarter of all high schools have a course on money. We'd like to see that close to 100%.
Yeah. So sticking on kind of the investment philosophy of Cambria, everything about it, like I really like. It's quant based, it's rules based. It seems to combine traditional analytics with trend following. So you kind of talk about the overall philosophy of how you look at building portfolios and over time, in theory, should yield some better results.
Yeah. So look, it's the best time in history to be an investor. Arguably, it's the most dangerous time also to be an investor. It's gone are the days of going to the grocery store and having 3 cereal choices. There's now 2,000. And so the challenge with that is you can get your healthy cereal that even exists, but you can also get your Fruit Loops and Frosted Flakes and everything else, And so in a world of Robinhood, 0-day trading options, multiple leverage ETFs, a lot of these meme coins, there's a lot of danger. But at the same time, you can buy an all-in ETF, global asset allocation, or a portfolio of ETFs for almost zero cost. So amazing time to be an investor. The whole key to all of this, starting from the get-go, people are always like, Meb, why are you launching funds? There's 10,000 plus funds out there. Isn't everything already covered? And we actually only try to launch funds that don't exist, meaning the methodology is something that either totally doesn't exist, it's a blue ocean opportunity, or we think we're implementing it sufficiently better, quote, it's different enough or better than the status quo, or it's cheaper. So all of our funds are cheaper in the category average. A couple are the cheapest funds in the category. But it has to be something I want to put my own money into. The average mutual fund manager has $0 invested in their own fund, which is insane to me. We want to have skin in the game. But it has to be something that there's a lot of academic and practitioner research, meaning there has to be support. And usually we publish a white paper, a book to go along with these. But as far as the philosophy, we're a bit unique in that we think there's a lot of ways to succeed in investing. And but there's maybe 100 times as many more to impale yourselves and ruin your chance of success. So avoiding those is equally as important. But at our basic core, you have to be an investor. And that sounds pretty generic. And the concept we use is you got to be the owner. If you look at a lot of the top, not even a lot, I think nearly all of the top celebrities, athletes, actors, singer-songwriters. They all made some money from their career, but they made the big money, right? Well, the ones that got truly wealthy from business and investing. So Michael Jordan, Jay-Z, Dolly Parton, Ryan Reynolds, on and on. You see, yeah, they made a decent coin from their day job, but where they really got wealthy was investing. So you have to invest. And what does that mean? It could mean, people buying houses. It could mean investing in the stock market. It could mean all sorts of different things. But putting money to work by far and as soon as possible, the decision to save and invest trumps every other decision. Now, we can then spend the rest of the time talking about, what you should invest in and why. But getting started, particularly for the younger cohort, is by far the most impactful decision and versus everything else.
So we're here to talk about your shareholder yield ETF and a little bit about the suite, but can you explain to the listeners and to the advisors listening, what exactly is shareholder yield? Because it is more than just traditional yield, right? It incorporates some other things. So can you talk about this idea of and why looking at entire shareholder yield is important?
Of course. So circling back to the comment I made earlier, which was we're only launching funds that don't exist. I think it's important. Everyone on TV is always talking about this time is different. This is new regime, something changed in markets. And often that's not the case. If you look back in the long arc of history, my favorite investing book is Triumph of the Optimist. So look at what's happened in all these various markets. You realize the past has been totally insane already, right? But you get a broad idea of what it means to have expectations for markets and what can happen. That way you have a bit of a guidepost to say, okay, well, I actually see that something structurally has changed, and something structurally changed in markets in the 1980s. And what it was is companies for forever have distributed. A company makes money, it decides to distribute that money to shareholders, right? They want some sort of income from the company. And you go back 100, 200 years ago, traditionally, they did it through what they called cash dividend. They simply just paid you a check, right? Well, when you have publicly listed stocks and private too, you have the ability as an owner they could buy back shares of the company or issue shares. Say, hey, we need some money. So GameStop just do this recently, right? We're going to issue a bunch more shares. And as an owner, you obviously get diluted if you issue shares, and you own more of the company if the company buys them back. First of all, use the word buyback and automatically shuts down people's brains. I don't know why, but it's one of the most misunderstood phrases in all of investing in corporate finance, which is odd because it's really a boring topic. It's never been illegal. It's been around forever. But in the 1980s, the government passed some rules that just gave companies a little more safe harbor, gave them a little more comfort in buying back shares on the public markets. And so buybacks, at their definitional core, this is freshman level finance 101, buybacks, if the stock's trading intrinsic value, is the exact same thing as paying out a cash dividend, full stop. And most people already, that shuts their brain down, but it's true. Now, the difference comes when a buyback is executed if the stock is trading below intrinsic value, so it's cheap, or it's trading above intrinsic value, it's expensive, because then it comes a transfer of wealth from the seller to the buyer, vice versa, right? Nobody understands this more than Warren Buffett. He's been writing about buybacks in his annual letters all the way back. We use a quote of his from the 1980s, where he's like, there's no better use of cash if a company's trading far below intrinsic value than to buy back shares. So what happened? 1980s, companies started buying back more shares. Now, why did they do that? For two reasons. One, stock buybacks are flexible, right? You don't have to pay. Like if you put out a dividend, companies are loath to cut them. It's a signaling mechanism, right? They want to make sure they maintain that dividend. It's very important. They cut it, all of a sudden the stock tanks because all the investors say, what's wrong with the company? So they're flexible. Second is they're tax efficient. If you're an investor in a high tax state like I am in California, the last thing you want is a company you own, a great stock, paying you a ton in dividends, because guess what? You have to pay tax on that. So buybacks are nice because it gives you the choice. I can sell or not. So what we looked at is you started to ramp up buybacks in the 80s, and starting in the late 90s, buybacks outpaced dividends in any given year, almost every year since the late 90s. Now, why is that significant? Because the vast majority of strategies, if you look at all these income funds that are based on dividends, totally ignore buybacks, and that's insane. So we wrote a book. It's free. We're doing a second edition this summer, hopefully, called Shareholder Yield, a Better Approach to Dividend Investing. And what that meant was if you looked at the combination, the holistic measure of cash dividends plus net stock buybacks, and net is important because of companies issuing shares, and this is particularly true in this cycle with stock-based compensation to the C-suite, you get a much more holistic view of income. And if you look back in the academic literature for the past, we did it for, I think, 50 years. Other academics have done it for 100 years on shareholder yield. It outperforms any dividend strategy you can come up with. High dividend yield, dividend growth, you name it. And so we launched a fund. Now we've launched 4, soon to be 5 funds by the time this podcast comes out on the shareholder yield concept. And it's one thing to do a back test and to publish academic literature. It's another thing to do it with real money. And we're happy with the performance of all these funds. We have a foreign fund, an emerging market fund. But basically, it gives you what you're really looking for in Ben Graham-esque security analysis, which is a high-quality business that's generating a ton of cash flow, is keeping the C-suite honest by distributing that cash flow to shareholders, but is also trading at a cheap valuation, not doing it with a ton of debt. You end up with a pretty nice portfolio. Sorry, that was a short-winded description of the topic.
No, it was perfect, and it walks perfectly into kind of an overview of, your largest shareholder buyback fund, which is SYLD. I think you gave us a very high level of what the fund is trying to accomplish, but is there anything in particular at a high level you'd like to talk about with SYLD before we kind of get into the nitty gritty of how it works?
Yeah. So look, it owns 100 stocks. It is size agnostic, meaning it can own the small ones, it can own the large ones. It goes wherever the opportunity lies. SYLD is US only. It caps the sectors at a third. We don't want to be all in on energy or tech or something like that. And then it updates once a quarter. So it has somewhere in between like a traditional index and an active management turnover, but in the ETF structure, it tends to be quite tax efficient. And at its core, it's a basic long only type of strategy. The positions are around 1%. And if they go up too much, we'll trim them. And if they go down too much, we'll add to them. But overall, it's probably one of our most plain vanilla strategies in the lineup.
Well, let's dive into it a little bit deeper then. So you talk about the screening process to get to 100 names. Can you go through the steps you take to kind of dwindle down your universe?
Yeah. So we start with the whole universe. And the first step is what the academics would call net payout yields. Everyone calls it shareholder yield, the vernacular. There's always so much jargon in our world, but it's basically cash dividend and net stock buybacks. So that eliminates 75% of the companies. I think it would be a surprise to most investors where if you look at the average company in the stock market is a net stock issuer. So they're issuing shares in a given year. And I think that would surprise people because you're getting diluted. I'll tell you what else would surprise people. There's a lot of dividend investors out there that say, hey, I bought this great high yielding dividend stock, yields 4%. But if you look underneath the surface, that company is issuing 5% in a market cap in shares. That stock actually has a negative yield. So let that sink in. Someone thinks they're buying a 4% yielder, but in reality, they're getting diluted. And that's the big risk, I think, for a lot of investors who ignore this metric. And part of the challenge is the buyback yield is a lot harder to dig into. If you go to Yahoo Finance, you go to Morningstar, they publish dividend yield, front page of every quote. Where do you find buyback yield? You got to dig around for the shares outstanding. That's changing. You're starting to see more and more people talk about it as the concept becomes more widespread. But so we start with that. That eliminates 75%. The companies on average coming into our portfolio have a double-digit shareholder yield. So let that sink in. That is a very large number. In the U.S., that is majority buyback driven. The culture in the United States is much more comfortable with the buybacks. than foreign developed and emerging, although that's changing. We then next do a valuation composite. So it's screening for very traditional value metrics. I don't think it matters that much. The whole point is you want to be on this side of the universe versus this side of the universe. Mainly speaking, you want the companies, on average, companies buying back a bunch of shares trade cheap. And on average, the companies issuing shares are expensive, but we don't want to take the CEO's word for it, right? We want to, like Warren Buffett says, he'll buy back Berkshire at 1.3 times book. So we want a similar methodology. We want them to be cheap on average. Again, we mentioned quality, so we don't want these companies to be over leveraged, just loading up their book with a ton of debt just to buy back shares. That was less of a concern when interest rates were zero. Now we're at 5%. I think that's becoming a very real consideration for companies. And the last thing we do, which is a bit unique, is you mentioned the intro, we're a trend following momentum shop. And on this final buy decision, so let's say we have a portfolio, 100 stocks already. There's two reasons companies get kicked out. Either their shareholder yield goes down a lot, or the valuation goes up too much. Good example, we owned Apple from 2013 to 2020. And Apple eventually just went up too much and got too expensive, right? The valuation metrics kicked it out. But let's say there's 10 names coming out of the portfolio. All right, well, we have our list. We've whittled down, and let's say there's 50 names that qualify. There's a final sort we do on intermediate term momentum to pick the 10 best on momentum, just like a classic French Fama momentum measure. And the goal there is to try to avoid the value traps, meaning companies that are cheap, but just getting cheaper and cheaper on their way to the cemetery. And so that's it. That's the basics for the fund. For the foreign ones, we cap the countries too. We don't want a third of the fund in any country. Right now in the U.S., there's very little tech exposure. So I think the biggest sectors are energy and materials and financials and industrials. Part of the problem with tech stocks in the U.S. is they tend to be on average expensive, but also they're serial share issuers. So they love to make it rain with the C-suite on stock-based compensation. That's actually not true in the foreign funds. The emerging market fund, tech is the number one sector, which I think is really interesting. Most people think value is an old, stodgy, fuddy-duddy category, but really it's time dependent and market dependent, where sometimes, and part of this is because emerging markets have done so poorly for the past 15 years, these stocks on average are much cheaper there than they are in the United States.
So how often, I think you might have mentioned this before, but how often are you rerunning the screen and kind of looking at that intermediate term momentum quarterly? And
an important note on this, on the momentum side, because most of our trend following and momentum strategies are much higher frequency than this, is it's only on the buy decision. If you run a strategy where momentum is on both sides, the buy and sell, you get way more turnover. And that's not the point of this fund. The point of this fund is we want a value strategy. However, adding the momentum filter and historical testing added about a percentage point in return. So it's worth doing. We just don't want to do it on both sides because it introduces turnover, which of course has a cost to it as well. But if you do it on the buy decision, it's costless because there's already companies coming in. You just kind of optimize the ones that you want.
Right. So do you have any industry or sector guardrails to avoid maybe some overconcentration? Is that part of, the rules-based process you're putting together for this?
A third, 30%, that ballpark. We don't want it to be an all-in utilities fund at some point. So it ends up with a pretty diversified basket, but it can express certain overweights at various points in times. And like mentioned, depending on the geography, can be different for the various geographies as well.
So I read you kind of start with this base, everything's equal weight. What drove that decision to equal weight everything? I know that there's some benefits there. And how often are you bringing things back in line after they drift? Does that align with that quarterly rebalance? Or
we kind of let them float intra-quarter. It's tolerance based rebalance. We don't really feel it matters that much, to be getting them back to 1% hyperactively. We will trim it if it gets above 5%, but for a stock to get above 5%, that means it has to be a 5-bagger. right? So that's a lot, but it happens
Yep.
because we've had to do this in the emerging market fund recently. There's a stock in there, and I used this as an example on TV not too long ago, and I said, all you guys do is talk about NVIDIA all day, and you should. I mean, it's a $3 trillion company on its way seemingly to four, one of the top stocks in the world, and it's been a monster performer. I go, how many times have you guys mentioned Hanmi? And they said, what? Did you sneeze? Like, what are you talking about? I go, well, it's a stock that's outperformed NVIDIA over the past 1 and 2 years. It just happens to be located in South Korea, but nobody cares about South Korea investing because foreign stocks have underperformed the US for so long. But this sort of leads into this huge opportunity right now where it's just twofold. If you look at market cap weighting in the US, so the big stock, everyone's talking about this, the S&P, but really dominated by these giant names. People call them the Mag 7 or whatever, but the S&P is expensive. Like there's no real way to mince words here. That doesn't mean it can't get more expensive, but on average, it's expensive. If you look at the shareholder yield basket, and you can go to any quote site, type in a ETF, we use Morningstar, and it'll give you an x-ray of the underlying holdings. And you look at the valuation, and across the board, it's cheaper, but in most cases, it's cheaper by half. And you have an environment that's setting up very similar to other periods. The two that I would cite would be late 90s and then the nifty 50s, where you had this high concentration in a certain amount of names, and then value type of strategies outperformed by a massive amount over the coming years. We did a tweet on Twitter where we said 2024 is shaping up to be one of the worst years ever for both an equal weight or small cap weight versus the S&P 500. And last year wasn't good either.
Right.
It was one of the worst years. You had to go back to the late 90s to have even a competing year. And the other one was 1929. Not a good sample size, right? But in the aftermath of that, guess what? I think it was like 12 of the next 15 years, small caps outperformed the large caps. So there's a massive opportunity for this kind of overlapping Venn diagram circle of both small versus large and value versus expensive that's setting up right now and could last, hopefully, not just a year or two, but for many years to come.
Yeah. So if you're working with an advisor trying to implement SLYD inside of their portfolio, they already have a diversified portfolio. Where are you kind of allocating to it? In large cap, I wouldn't say large cap growth, or would it be in that large cap growth sleeve?
What most people do is one of two things. They do the Lego or building blocks approach. So if they have a 60-40 allocation at 60% S&P, they'll replace some, and less often they'll replace all the stock exposure with this fund. So maybe they'll replace 10 or 20% of their stock allocation with this fund. There's people that are a lot more focused on style boxes. So they do large cap growth, large cap value, mid cap growth, mid cap value, in which case they'll use this fund as the mid cap value category. We have a small cap version of this, which is MYLD. LYLD is our large cap version. And then we have foreign emerging. We're trying to give people as many choices as they want. Investors were coming to really appreciate, love the specific exposure. So we think that we were really excited to get the small cap fund out because we said this is an opportunity in time that may not last forever. So we want to get this fund out, and that launched in January, and that's MYLD. And that focuses on the smaller names in the universe.
Yeah, well, jumping to that, because I did want to touch on the other ones in this category. When looking at small and mid cap companies, I'm making an assumption they probably have less opportunities for finding shareholder yield, but potentially more opportunities for that pop and long-term growth. Has that kind of been your experience when looking at the small caps and mid cap space?
Small caps right now, there's a large chunk that are unprofitable. And, the shareholder yield, by definition, the company doesn't have to be profitable, but to distribute 10% of your cash flow per year, you either got to be generating gobs of cash flow like Apple, or you got to have a ton of cash in the first place, or both. So almost invariably, we're going to screen out the unprofitable companies. And on top of that, the unprofitable companies, by definition, are almost always share issuers. right? They need funding. It's like a biotech stock, right? So
Right.
you got to think about a biotech stock. Now, on average, unprofitable companies, expensive companies, not good investments, but why are people attracted to them? It's the lottery mentality, right? Because you see the one that eventually makes it. You say, oh man, look at that 10, 100 bagger. But on average, it's a terrible investing strategy. And if you look at things like market cap weight versus equal weight, on average, the equal weight and then value strategies like shareholder yield outperform. There's a great study by Robeco that looks at what they call conservative investing, but it's basically shareholder yield. They take it back to the 1800s, and they find that usually these type of strategies don't really keep up in the romping, stomping bulls. Now, this fund has kept up, which is great. But we've had 4 times in history where the S&P has done 15% per year for over a decade. And we're in one of those periods now. And the other 3 were the internet bubble, the nifty 50s, and roaring 20s. So it's not totally unique, but it's rare for stocks to have just crushed it for this long. But the good news is this type of strategy, historically speaking, has done well during the sideways periods and the bad periods for the broad market. Because what do people flock to in bear markets? Well, they want quality. They want high cash flowing type of companies. They don't want the lottery tickets that may pay off. And often, as we've seen in prior bear markets, those can have pretty nasty declines from top to bottom.
Well, and touching on the other 2 shareholder yield ETFs you guys have, which is foreign and emerging, international markets, as you touched on briefly, have been really rough over the last handful of years in comparison to the U.S. market. Are you starting to see any more relative value over there, or are we still kind of in a waiting period for internationals to maybe have their day again?
We put out a recent article called The Bear Market and Diversification, which was referencing really since this bottom in 2009, U.S. stocks doing 15% a year compound, and astonishing. But the SPY has just mowed down everything else. Doesn't matter what it is, bonds, real estate, foreign, emerging, everything else is underperformed. But on average, and historically speaking, foreign stocks and U.S. stocks, it's a coin flip. What tends to do better in any given year and over time. There's markets that have been better than the S&P, thinking of Australia and South Africa, historically speaking. So the U.S. isn't at number 1 on the list, but it's up there. It's been great, no question. But it's been particularly great since 2009. And if you look at a lot of the outperformance, we have an old tweet, and I will get the dates wrong now, but I said over the past 70 years, U.S. stocks have beaten foreign by 1% or 2 a year, creating this much wealth in the end. How much of this outperformance has come since 2009? And the answer is all of it. So if you look at the valuations, our buddy Cliff Asness at AQR did a comment where he said over the past 30 years, it's like 80% of the performance difference in U.S. versus foreign has been in multiple expansion, meaning U.S. stocks getting more expensive and foreign stocks not. So you have this giant alligator jaws since 2009, where the U.S. has gone from a long-term, we like to use the 10-year PE ratio, from a PE of 12 to 35 today. Now it's not as high as 41 a couple years ago, and it's not as high as 45 in 1999, but it's not cheap. But foreign developed and emerging on average, largely due to the performance, have not. So their foreign developed is sort of high teens, foreign emerging is sort of mid-teens. But underneath the surface, the cheap, high quality, we're definitely talking single-digit PE ratios. Now, the companies in foreign developed and emerging tend to have that history of dividends more, right? So they're paying out closer to half in dividends. So you'll see these funds yielding 5, 6, even 7% at times. But these funds, I think they turned the corner in 2021, really at the peak of that craziness. And if you look at the foreign and emerging strategies, really having a great year this year. Now in the U.S., it's crazy. U.S. market cap weighted is doing awesome. Everything else, I think small caps are down a handful of percent on the year. Mid caps not doing much. So, but however, foreign developed and emerging very quietly, I think it's kind of getting hidden by the S&P. Still creaming everything. They're having a great year, and I think they're certainly set up for some really exciting returns going forward.
Well, just kind of like one last question as we close up here. You have a very diversified suite of funds. if you can go back a decade, what kind of drove that decision to launch the first one? And what is kind of driving you to continue to diversify? We just had Jerry Parker on. I saw you guys just launched MFU together. It was fun to connect with him. So do you continue to see yourself expanding that lineup and growing the suite?
Jerry, one of my favorite people in the world. Listeners, if you haven't heard his story, it's really great. So go back and check out that Behind the Ticker show. The criteria of investing in what do I want to put my own money into is really the number one. And so if you look at our suite of funds, half of our brain is value related. The other half is trend, which you just referred to. So we have a handful of trend following funds. And in value, I think is a lot more accepted as a classic investing style. Warren Buffett and others have done a great job promoting it. Trend following, despite being around just as long, is a little more esoteric. And I think we're probably the most non-consensus registered investment advisor in the country, where we run 3 allocation funds. Our default allocation, which we detail in the paper called the Trinity Portfolio, is half in trend type of strategies. And I don't know an RIA in the country that does more than like 10 or 20%. And already, if you allocate 10 or 20, you're in the 1% of investors. Most people do buy and hold, globally diversified allocation. That's it. But trend following to us is really the premier diversifier to a traditional portfolio, particularly during the bad times. So it shows its stripes done well in 2022, in COVID, and certainly in 2009, and then the internet bubble burst. And it's actually having a great year this year. There's an old Peter Bernstein quote I keep repeating recently that I love. He's like, asset allocation is a defensive strategy, but it's also an offensive one because you never know where the next big gains are coming from. And so the trend followers this year, they got a big position in cocoa or things like that. But in 2022, they were short bonds. It's really the only thing that helped protect those portfolios because everyone owns bonds and everyone owns U.S. stocks. And when both did poorly, there was nowhere to hide. So trend following is certainly a big component. We launch funds that we want to use. And in some cases, like we have a tail risk ETF, we look around and we use tons and tons of ETFs from other companies. So we look around and we say, hey, is there a good inverse fund out there? And the problem was most of them were either too complicated or too expensive. And I said, well, let's go build one. We did that with a global REIT ETF. I said, I don't want just a US REIT. I don't want a foreign one. I certainly don't want market cap weighted because these funds don't yield anything. So when they get killed and go down 50, 70%, I want to have the high quality value exposure and I want it to be global. Well, that didn't exist. And so, most of our launches are under this banner. And look, man, you go back, it's now over 11 years for shareholder yield. And you say this has been one of the best performing, I think it's the number one performing fund in its category since inception. One of the best things all our friends in the ETF world are good at is copying what's been working. I mean, how many AI funds have we seen in the past year? What's popular? The world has yet to embrace shareholder yield. And half the time I'm like, all right, that's a good thing because, we're the only people doing it. The other half time I think, am I crazy? Why isn't the world coming around to this? And part of that is just, once you have a built-in narrative and you have hundreds of dividend funds, it's hard to shift and say, okay, just kidding. We need to start incorporating buybacks because there comes a shift in narrative. And then people say, well, why didn't you do this 10, 20 years ago? That's right. So we'll see. I'm sure Vanguard or BlackRock or State Street will launch a shareholder yield ETF in the next year. So we got our wager on who will be first.
Well, it's had a lot of success so far. And Meb, I can't thank you enough for the time. Before I let you walk out of here, where can people learn more about you and find a list of all your Cambria ETFs?
Not too many Mebs in the world. So if you Google Meb Faber, you'll find me in all sorts of places. We put out the content on our podcast, The Meb Faber Show. We have the free email service that I'm told goes out to 150,000 investors, not 100,000. That's theideafarm.com. You can watch me pick fights on Twitter. But the day job is cambriafunds.com, where you can find information on all of our current and upcoming ETFs.
Well, again, thanks for being here. Enjoyed it.
Awesome. Thank you.